Demystifying short interest. How it shapes the financial markets. Short interest is a fundamental concept in the world of finance, with profound implications for the market and investors. In this article, we explore what exactly is short interest, the basics of short interest, and its impact on the financial markets. What is short interest? Short interest is a metric that measures the number of shares of a particular stock that have been sold short by investors. To sell a stock short, an investor borrows shares they don't own and sells them in the hope that the stock's price will fall. The objective is to buy back the shares at a lower price later, returning them to the lender and profiting from the price difference. In essence, investors look for stocks where they may have seen or read news or have determined from their research that the company of that particular will experience a negative event that will result in current investors wanting to sell their shares, resulting in the price falling. Key components of short interest. To fully break it down, let's look at the key components of short interest. Short sellers. These are investors who believe that a particular stock's price is overvalued or will decline in the future. They borrow shares and sell them on the market. Borrowing. Short sellers need to borrow shares from a brokerage or another investor before they can sell them short. The borrowed shares are usually provided by other market participants who hold the stock. Covering. To close a short position, short sellers must repurchase the same number of shares they initially sold short. This process is known as covering and is done to return the borrowed shares to the lender. How does short interest affect the market? Short interest can have several significant effects on the financial markets. Price volatility. Short selling can lead to increased price volatility. When short sellers sell a stock, it puts downward pressure on the price. As they cover their positions, buying pressure may drive the price back up. This tug of war between short sellers and long investors can lead to price swings. Contrarian indicator. High levels of short interest can be interpreted as a bearish sentiment indicator. If many investors are shorting a stock, it suggests a prevailing belief that its price will decline. Conversely, a high level of short interest can lead to short squeezes, where a stock's price surges as short sellers rush to cover their positions. Liquidity and borrowing costs. When short interest in a stock is high, it may become more challenging to borrow shares to sell short. Borrowing costs can increase as lenders demand fees or interest payments from short sellers. This can impact the availability and affordability of short positions. Market sentiment. Short interest data can be used as a gauge of market sentiment. For example, if short interest in a particular sector increases, it may indicate concerns about the sector's health. Investor sentiment. Investors may monitor short interest data to gauge market sentiment for a particular stock. High short interest might indicate skepticism, while low short interest may suggest bullish sentiment. Risk management. Short interest can play a role in risk management for investors and traders. Understanding short interest data can help traders make informed decisions and adjust their strategies accordingly. Conclusion. In conclusion, short interest is a critical component of the financial markets, affecting price movements, market sentiment, and trading strategies. It's a valuable indicator that provides insight into the dynamics of investor sentiment and can help investors make more informed decisions. However, it's essential to approach short selling with caution, as it carries risks and can lead to unexpected market outcomes, such as short squeezes.